Yep, I know. Funny that a channel called Smart Money is talking about crypto. Calm down, crypto bros, it's a joke. Ah yes, crypto, the most controversial thing in finance over the last 5 years. Watch until the end to understand an actual usable strategy to invest in crypto. There seem to be only two camps of crypto investors at the moment. Those who don't invest and those who shill every dog coin that they see while tweeting at Elon Musk to pump their coin. So we have the non-believers and the full-blown Kool-Aid drinkers. And to be honest, I can't tell which side is more condescending about it. There has to be a better way. So let's talk about technical analysis. First thing is we're going to draw these lines on the chart. You see how they form the shape of... Alright, nope, I'm kidding. This is a real investment channel. So let's give this a shot. First, I like to think about myself as my crypto investments as a venture capital fund, just with 0.01% of the total capital invested. Venture capital is a type of investing where investors put relatively small amounts of capital into a lot of small and new companies. Sounds like crypto so far. These funds typically expect at least 40% of the companies they invest into to fail completely, and another 20 to 30% to break even on their investments, but for only about 2 in 10 investments to produce 10 to 100 times returns. Sounds like these people are professional degenerates. Perfect for crypto investors. And to back this point up even more, famous venture capitalists like Marc Andreessen and Peter Thiel have been backing more and more crypto projects in the last 2 years. Alright, so you decided you're going to gamble on a crypto portfolio. How can we do our best not to get wrecked? The first thing a reformed crypto bro should look for is a narrative. If we're going to have any chance here, we need to think of crypto projects as young companies and stay away from the dog coins. Let's start with the time horizon for your trade. The typical VC fund has a time horizon of 6 to 10 years before they look to start cashing out their investment. Who knows if a crypto project is going to last that long, so let's cut that in half. How about 3 to 5 years? The point is you're investing for the long term. Venture capitalists need to think about the potential of a company many years into the future. To do that, they need to come up with the best case scenario story for what the company can become. And that's what they do for crypto as well. Aswath from NYU Stern is well known for his business valuation techniques. In a talk he did at the Alpha Summit in 2022, he talks about creating a narrative. He says you don't have to believe the stories the business is telling you, but to take a narrative into account when valuing a company with very little financial data available. In the presentation, he's talking about Twitter and Lyft, so not exactly crypto, but close enough for our purposes here. And it definitely is a stretch to say these crypto projects have any financial information available, but we'll go with it for now since we have nothing better. Common crypto narratives that are circulating the bowels of Twitter and Reddit include institutional money is beginning to believe in crypto, Web3 is going to change the internet, and the metaverse is going to be important. Man, to be honest, I hope the metaverse isn't true. Feels like that would end up like the Matrix somehow. First, I wake up in a virtual reality mansion next door to Snoop Dogg, and the next thing I know, I'm eating goop fighting off robots. So, I will not be investing in the metaverse for that reason. But if that's the future you want, please go ahead and fund it. Remember, this timeline is 3 to 5 years, so the story or narrative should be a similar time frame, and explain how the crypto project survives for that long. For now, we're going to exclude NFTs. They might be important eventually, but buying pictures of animals for a year's worth of your salary seems like a bad idea at this point, even if Gary Vee said it's the next Facebook. To be clear, you should probably think up your own narrative and not copy one from an anonymous guy on the internet, but that's up to you. Although he isn't a crypto investor himself, the key points Aswath highlights seem relevant to this kind of investing. Diversify. VC funds are highly diversified. Maybe use the Kelly criterion to come up with an idea of how much to invest in each coin. Shameless plug, but check out my video on that to learn more. Focus on survival. So in the case of crypto, that probably doesn't mean YOLO all your money into a Ponzi yield farming token. If you don't know what that means, lucky you. You probably didn't lose all your money on one looking for 10,000% APY. Again, make sure the narrative for the project supports a long-term survival. And be ready to be wrong. Again, like we said, we expect 60 to 70% of these to be worth nothing at some point. And in crypto specifically, I wouldn't be surprised if 90% of projects went to zero. This is probably the biggest key. Next, we need to consider dilution. Be careful to look at the tokenomics of a crypto project before investing. This is similar to a stock's buyback or issuance schedule. The issue is these projects often pay their staff in tokens and release new tokens to their investors at various project checkpoints. Dilution is not an instant disqualifier, but it does mean you need to be right about two things: the success of the project and how fast it sees success. It's already hard enough to be right about the project's success, so do yourself a favor and look out for the dilution. The token release schedule is likely to be buried in the white paper of the project on their website. Most of these websites are terribly designed and impossible to navigate, but I'm sure this isn't intentional. They typically have profound pictures of space or oceans and have profound quotes to distract from the lack of substance in the rest of their documentation. So make sure you scrutinize this before considering a project. This is an example of what to look out for. I'm sure you're smart enough to realize if the number of tokens increases in a nearly vertical line, that is probably bad for you. Now let's look at the charts. This is probably how most of you decide to buy or sell a cryptocurrency, and somehow, I know most of you don't look for this. You probably open up Twitter, go to your favorite anonymous crypto influencer's page, and buy whatever he's pumping. Not your best idea. You know what I just realized? Anonymous crypto Twitter accounts are like Finstas for guys. Hopefully you guys aren't boomers and know what a Finsta is, or maybe I'm so old Finstas don't exist anymore. Let me know if they still exist. When looking at a chart, if you see a price action that looks like this, basically a vertical line, stay away. Think about this rationally. Is it more likely new people are going to keep bidding it higher, or people that already have massive gains will start to sell and take some profits? Exactly. Don't be the one holding the bag. Since it can be difficult to get in on pre-sale prices like real VCs, retail investors will need to be more patient. Many new projects sell off hard on their initial releases as VCs and early investors liquidate their holdings. That's where you need to be patient. Once you see a chart starting to bottom out like this, now you can think about investing, especially if you can verify that it is back to VC pre-sale prices. This information can usually be found in white papers of projects as well. To be clear, I'm down bad using this, but it feels better than having crypto influencers yelling at you to buy their coin that they bought weeks ago just for you to get wrecked when they sell. So yeah, I'm gonna go with this strategy. So now that you know how to invest crypto like a VC, try watching this video to help size your investments.